Welcome to The Explainer. Today, we are jumping right into the numbers behind what is genuinely one of the market's most fascinating statistical mysteries right now. We're looking at a company called Hut8, trading under the ticker symbol HUT. If you love market anomalies, financial puzzles, and really just digging into the data to figure out what on earth is going on behind a stock's curtain, well, you are in exactly the right place. We're going to decode what I'm calling the 500% paradox, relying strictly on the raw financial metrics from their latest data. So grab your notepad because this gets incredibly interesting.
I want to anchor our entire conversation today around this single, staggering number, 515.60%. That is Hut's trailing 12-month return. Just let the sheer scale of that explosive market performance sink in for a second, right? In a market where, a 10 or 15% annual return is often considered a huge win, we are looking at an asset that has effectively multiplied its investors' money more than 5 times over in a single year. It's exactly the kind of explosive, parabolic price action that forces you to stop and ask, what exactly is fueling this rocket ship?
But looking at the historical yearly returns, wow, this hasn't exactly been a smooth ride to the top. Just look at the absolute roller coaster nature of these numbers. Back in 2022, the stock suffered a brutal plunge, wiping out nearly 90% of its value, landing at negative 89.17%. But then, the switch completely flips. Look at the compounding years of staggering growth that followed. Up 213% in 2023, nearly 54% in 2024, another massive 124% jump in 2025, and it's already up almost 65% year-to-date in 2026. The volatility here is absolutely breathtaking. I mean, this is a stock that can literally decimate a portfolio one year and make a fortune the next.
Section 1. Peeking under the hood. Let's see what's actually driving this thing.
Look at this stark, almost unbelievable contrast. On the left side, you've got the market's roaring approval, an $8.37 billion market capitalization, backed by that phenomenal 515% trailing return we just talked about. But look over at the right side. This multi-billion-dollar company has a trailing 12-month net income of negative $53.35 million. And it gets worse. Their free cash flow over the last 12 months sits at negative $292 million. That means they are currently bleeding cash. They're operating at a severe net loss. So the market is valuing them like a gold mine, but the actual cash registers, they're practically running on empty.
Now, when a company operates in the red like this, your standard valuation multiples just kind of break down. Take the negative PE ratio, for example. It's a really common anomaly in highly speculative tech and mining sectors. Essentially, it tells us that standard valuation models based on profitability are completely useless here. You just can't value the company based on profits because, well, currently, there aren't any.
And just to show you exactly where Hut stands, their current PE ratio is negative 106.73. Think about what that actually means. For every share you buy at an $8.3 billion valuation, you are buying a slice of compounding operational losses. You aren't buying earnings. You're effectively subsidizing their cash burn. The market is very clearly not buying this stock for its present-day reality. They're buying a narrative, an expectation, or some massive future potential.
Section 2. The Valuation Puzzle.
Okay, so look at the expansion in the price-to-book ratio. The trailing 12-month average was 5.27, but it has rapidly expanded to 8.21, meaning investors are paying a significantly higher premium today for the exact same underlying assets than they were just a few months ago. The multiple is stretching further and further from its own recent baseline.
And the puzzle gets even more extreme when we look at the price-to-sales ratio. The trailing average was 34.13. Today, it sits at 62.98. That is an 84.5% jump. Paying $63 for every single dollar of sales is an astronomical premium. It really showcases that the market has priced in a colossal amount of future growth, completely regardless of current operational efficiency.
But wait, this brings us to a total paradox. While the price to sales is astronomical, Hut's PEG ratio sits at just 0.83. Traditional metrics are pulling us in entirely opposite directions here. We have highly stretched top-line multiples, yet a PEG that teasingly suggests the stock could actually be undervalued relative to its expected growth trajectories. The data is completely contradictory. It's like a giant puzzle with pieces from 2 totally different boxes.
Section 3. Debt and survival metrics. How are they actually staying afloat?
Let's do a rapid-fire health check. Look at these key survival metrics.
We've got a debt-to-equity ratio of just 0.35, and both current and quick ratios are sitting quite comfortably at 1.26. Unlike the messy profitability data we just explored, this balance sheet actually looks remarkably stable. They have more than enough liquidity to handle their short-term obligations without breaking a sweat.
And the crucial takeaway is perfectly summarized right here. Despite the negative cash flow, debt remains relatively low. Basically, Hut is highly liquid and unburdened by excessive debt. Sure, they might be losing money on operations right now, but they aren't drowning in loan repayments. Their underlying financial structure is acting as this really sturdy life raft, allowing them to weather this period of extreme negative cash flow, all while the stock price continues to surge.
But looking at the long game reveals yet another split reality. We have a positive 5-year compound annual growth rate for revenue at roughly 10%. So money is coming in the door at a steady, increasing pace. But look to the right. The net income 5-year CAGR is exactly 0%. Zero. A complete flatline. There is a profound long-term discrepancy here. They've been consistently bringing in more revenue over the last 5 years, but they have completely failed to translate that top-line growth into bottom-line net income growth over the exact same period.
Section 4, the final tally. Let's pull this all together.
All right, so here is the distilled reality of the Hut paradox. First, we have undeniable, astronomical price action with a trailing return of 515.60%. The market absolutely loves this stock right now. Second, this is all happening while the company operates with deeply negative cash flow, burning through $292 million. Third, to buy in right now means paying significantly expanded valuation multiples, like that staggering 63 times sales. And finally, the whole reason the company hasn't collapsed under the weight of its own operational losses is that it is protected by remarkably low debt, with a debt-to-equity ratio of just 0.35.
Which leaves us with the ultimate question. With astronomical returns but purely negative earnings, is Hut's momentum actually sustainable? I mean, we've seen the 90% drops in the past, and we've seen the 200% rallies. The balance sheet definitely keeps them alive today, but the valuation demands absolute perfection in their future growth. So, is this a forward-looking market accurately pricing in a huge future turnaround, or is it a speculative bubble ignoring fundamental realities? I'll leave you to ponder that as you look at your own portfolios. Thanks so much for joining me on this deep dive into the numbers. Keep exploring, keep questioning, and I'll see you on the next Explainer.